Hi, and welcome back again to Options and Volatility, Hedges and Edges, taking a look at our most recent trade today, a put calendar spread trade on IONQ, where a overvalued, overbought, overextended stock that had a very nice term structure volatility edge as well sets up ideally for a put calendar spread trade. So let's jump in and take a look. First, here is the actual alert that came out today. So you can see IONQ getting extremely overbought on a technical basis. We'll see that in a second. IV has moved from higher short-term versus longer-term as well. So that term structure volatility flipped very advantageously in our favor as well. And the stock absolutely getting to extremes of valuation. So let's position the profit. From a pullback, doesn't even have to be much of one to profit, right? With a put calendar. So going out buying the traditional December 12.5 puts and then selling against it to hedge the shorter term November traditional 15th expiration puts, paying just 40 cents for that spread. So we always like to do that. So as we talked about that term structure volatility, you can see now those Novembers we are selling, trading over 100 IV. The Decembers that we hedge with, right, under a 90 IV, so a very nice term structure vol edge. Here you can see the spread. This is the time the recommendation was sent out, trading right at a 40-cent net debit. You can also take a look on a longer term basis. Here is basically the IV 30, 60, and so on longer term. But you can see the shorter term, basically the November IV highlighted in green here, right, has really shot higher compared to the DECE IV, the 60-day in red, which has climbed a little, but certainly not surpassing the previous peak, right? Has remained somewhat contained, whereas shorter-term vol off the charts here. Here you can see that chart, how that's expanded, especially on the short end. A month ago, actually, the short-term 30-day IV was trading a discount to the 60-day IV. Taking a look at specifics here, I pulled off the 30 delta puts on a 30 and 60-day basis, and you can see basically over the past month or so, a couple months, basically pretty much co-aligned, a few little variations, but over the past several days, right, we've seen this huge spike in the short-term IV compared to the slightly longer IV. So November ripping to fresh new highs by far. December basically staying well contained, hasn't broken the previous peak here. So that sets up, really ideally for that put calendar spread trade too, where you benefit from this term structure volatility, i.e. the relationship for these to flatten out. In other words, November IV to drop quickly compared to December, the option we sold to fall more quickly than the option we bought. And we talked about, the technicals and so forth in the rally. Here you can see the explosion in the stock, and this really led to a flooding in of short-term, IV, everyone playing short-term to capture this kind of, mania to the upside, a poster child of a parabolic stock move, to say the least. We all ultimately know how it ends. It's a question of how far will it continue to rip until it does. Hence the, put calendar spread trade, I think ideal where you have 40 cents at risk, right? And if you're off by a day or two, it's not going to affect the spread price, right? Because those options will move certainly together. But shares trading at a massive premium to the 20-day moving average, 9-day RSI, over 85 at by far the highest level over the past year. Bollinger percent B over 100 again. You can see previous times like here, right? Like kind of here and certainly back here. It's marked significant kind of pullback opportunities in the stock, and MACD at the most extreme reading of the year as well. We talked about the valuation. Here is price to sales, right? I like to look at that because it's, especially for these kind of stocks, a more clean number. But now price to sales over 100, right? It was trading Thursday's close, right, at 85. So it's exploded just in a couple trading days here. By far the richest fundamental valuation we have seen over the past 6 months, not even close, has basically doubled from back here, September 19th. So in essence, about a month time, we've seen price to sales move from 50 to over 100, right? So the valuation has doubled as well. These extremes do not last long and usually are a sign that things have gotten out of hand, and a pullback or a counter trend move may be in the offing. And then we always like to look at the fill prices. So pulled off the fills from today. So everyone getting filled at 40 or 41 cents, give or take. The original trade was 40 cents with 3 cents discretion. And you can see here, able to capture that nice term structure volatility edge, selling 103 in essence, IV 102.92 on the November 15th being sold here on this spread, right? And then hedging with under a 90 IV. So again, the spread doable, able to capture a very nice term structure valuation, extreme in that term structure volatility, able to capture that, and extreme in valuations, to say the least, price to sales over 100, right? And extreme on a technical basis, every technical metric off the charts at high readings of the year. So things certainly look for a probabilistic pullback. Doesn't mean they necessarily will happen, right? This is trading after all, but certainly paying a cheap price, only 40 cents to get in. Plus we have the weeklies between our November 15th expiration that we sold and the December 20th expiration that we bought. We have a set of all those weeklies in between to continue to hedge, to chop wood, to defray that cost, harvest premium. So this is another factor I like, these kind of put or call calendar spread trades that have a nice time differential between the option we are buying and the option we're selling. So until next time, here's the good trading. Take